Welcome back to Daily Stock. Is the American economy really thriving? The latest data has left many puzzled. Some are asking, are we entering a new economic golden age, or is a downturn just around the corner? In a surprising move, Trump fired the head of the U.S. Bureau of Labor Statistics. The big question now is, will U.S. employment data become less reliable going forward? Lately, many have pointed to Trump's policies as delivering real results. Over the past 3 months, while trade negotiations between the U.S. and countries around the world intensified, the U.S. economy has shown remarkable strength. Monthly job gains have consistently beaten expectations. The unemployment rate has hovered around 4%, a near-historic low. Inflation has stayed surprisingly stable. And the dollar, which took a hit during Trump's global trade war, rebounded sharply, rising 2% in a single week since late July, the biggest one-week gain this year. Meanwhile, the U.S. stock market has been on a tear. The S&P 500 hit record highs 9 times this year, and the Nasdaq has topped all-time highs 10 times in 2025. On top of that, a major tax cut bill just passed, further boosting investor confidence. Against this backdrop, Trump's trade agenda has started to deliver significant wins. Just before key deadlines, the U.S. struck favorable deals with the European Union and several major trading partners across East and Southeast Asia. Under these new agreements, countries must pay 15–20% in tariffs to access the U.S. market, while opening their own markets fully to American goods. This 15% tariff rate has become the new standard for favorable trade status. In addition, countries seeking these benefits are required to invest hundreds of billions into the U.S., a condition Trump has dubbed America's signing bonus. Only 4 months ago, these demands would have seemed outrageous. Now, they're becoming widely accepted as part of a new global trade reality. Around the world, people are saying, Trump has won big. The idea that his presidency would usher in an economic golden age no longer sounds like an empty campaign promise. For many, the U.S. economy and stock market have become the go-to investments for effortless wealth building. But since July 30th, new economic data has started to cool that excitement. On Wednesday, July 30th, the U.S. Department of Commerce released the second quarter GDP report. At first glance, it looked impressive. Adjusted for inflation, the economy grew 3%, a sharp turnaround from the negative growth in Q1. But a deeper look reveals some troubling signs. In Q2, consumer spending by average Americans barely budged. In Q1, GDP dropped by 0.5, an unexpected contraction. Then in Q2, it bounced back with a 3% gain, also unexpected. These swings are largely due to changes in U.S. import activity. Here's why that matters. When calculating GDP, imports subtract from the total. High imports drag GDP down. Before Trump took office, many U.S. companies anticipated the promised trade war and rushed to stockpile inventory in Q1, which led to a spike in imports and depressed GDP. Then in Q2, as Trump's global tariff negotiations heated up and rates fluctuated wildly, companies adjusted again. This time, imports dropped sharply as firms stopped stockpiling, helping to boost the GDP number. So part of the 3% GDP growth in Q2 was due to a simple math trick. Fewer imports made the economy look stronger on paper. But if you strip away inventory adjustments, trade impacts, and government spending and focus purely on domestic demand, the picture changes. Real domestic demand grew just 1.2% in Q2, the slowest pace since the end of 2022. And the June data shows no sign of a rebound. Consumer spending, long the engine of the U.S. economy, has gone flat. That's a red flag, especially since personal consumption makes up about 69% of GDP. On Thursday, July 31st, the Bureau of Economic Analysis released June's personal income and spending numbers. The takeaway? Incomes and spending only grew in line with inflation, meaning that in real terms, Americans didn't spend more. That confirms what economists feared. Consumer spending stalled throughout the entire second quarter. The most shocking U.S. economic news came on Friday, August 1st, when the Department of Labor released its July employment report. The numbers were far below expectations. Only 73,000 jobs were added last month. But the real shock came from the major downward revisions to May and June's job figures. The revisions were so drastic, it was as if someone moved the decimal point. The Bureau of Labor Statistics had originally reported 144,000 jobs added in May. After the revision, just 19,000. June's number dropped from 147,000 down to only 14,000. In total, May and June's job creation was reduced by a staggering 260,000 jobs. Including July's weak numbers, the last 3 months, May, June, and July, now represent the worst stretch for job growth in 15 years, not counting the pandemic. Despite this, the unemployment rate has remained relatively stable, rising only slightly from 4.1% in June to 4.2% in July. Trump, furious over the revised data, took swift action. He fired Erica McIntyre, the head of the Bureau of Labor Statistics, blaming her for what he called misleading and politically manipulated job numbers. On social media, Trump pointed out that McIntyre was appointed under President Biden, accusing her of inflating job numbers during the 2024 election cycle, including an alleged overstatement of 820,000 new jobs in March 2024 and an additional 110,000 in August and September, just before the election. He noted that after he took office in 2025, employment figures consistently got revised downward, this time by as much as 90%. Trump said, "Critical data like employment numbers must be fair and accurate, not manipulated for political gain." He pledged to install a more capable and qualified person to lead the Bureau. For decades, U.S. economic data has been regarded globally as a gold standard. Policymakers, including those at the Federal Reserve, rely on it to make informed decisions about interest rates and economic direction. Investors, businesses, and individuals also use this data to plan and forecast. That's why the idea of politicizing this data, whether real or perceived, triggered immediate backlash. While Trump's supporters, including his Secretary of Labor, praised the decision, many economists and former officials expressed concern. They warned that firing a statistician over politically inconvenient data could undermine trust in the objectivity and independence of America's economic reporting institutions. But is this really about politics? Or is something else going on? A closer look at how the Bureau of Labor Statistics, BLS, collects employment data suggests a more nuanced issue. In reality, it's unlikely that any single official has the power to manipulate results. Here's how it works. Each month, the BLS surveys roughly 120,000 businesses and government agencies, representing about 26% of all non-farm employment in the U.S. These surveys focus on headcounts, hours worked, and wages for the payroll week that includes the 12th of the month. The data is voluntary and collected mostly via phone and online submissions. In the first release each month, BLS typically uses responses from about 60% of those sampled. For June, the response rate was 59.5%, within normal range. The remaining responses trickle in over the next month or two and are used to update the numbers in later revisions. Importantly, the BLS doesn't just average numbers. It also uses mathematical models to adjust for seasonality, for example, construction slows in winter, and to estimate the impact of new business openings or closures. These models are based on decades of economic behavior. In theory, if the initial 60% sample is representative, the final results shouldn't deviate significantly. But lately, they have. Since 2022, the first estimates have repeatedly overstated job growth, requiring large downward revisions later. In May and June 2025, the scale of the correction, nearly 90%, has made many question whether the current system is still working as intended. There will always be some variation. Some months may come in higher, others lower, but the initial job numbers shouldn't consistently overshoot the final figures. Unfortunately, since 2022, the Bureau of Labor Statistics, BLS, first estimates have routinely come in too high. Over the past 3 years, these inflated early numbers have almost always been revised downward, so much so that the practice has become the new norm. In some cases, the corrections have been dramatic. For example, May and June's figures were revised down by as much as 90%, essentially rendering the original data useless. This persistent problem has been widely attributed to underfunding. The argument is that the BLS simply doesn't get enough financial support from Congress to modernize its operations. What's more, the responsibility for collecting and publishing official economic data is divided among multiple government agencies, many of which have faced budget shortfalls for over a decade. That makes consistent, high-quality data collection more and more difficult. Another factor? Outreach methods are outdated. Surveys are often conducted over the phone, but people rarely answer calls from unknown numbers these days. And while government agencies and large corporations are more likely to respond, small businesses, which are more representative of Main Street hiring, tend to opt out. That skews the sample. The BLS explained the sharp downward revisions for May and June by citing late responses from businesses and institutions. As more data came in, the Bureau adjusted its estimates. Normally, these adjustments are a mix. Some industries get revised upward, others downward, and they tend to balance out. But in June, nearly every sector saw downward revisions. The late responses were overwhelmingly negative. The public education sector was particularly off the mark. The number of school employees reported in June ended up being about 110,000 lower than initially estimated, and the seasonal adjustment formula used that month significantly influenced the final results. The deeper issue is this: the Bureau of Labor Statistics is still relying on a data collection and analysis system that was designed decades ago, and it's no longer working. It's completely out of sync with today's economic reality. The recently fired bureau director likely knew this. After all, she has a background in statistics. The BLS also has advisory committees of experts specifically tasked with recommending improvements. So why hasn't anyone stepped in to fix the system? The answer is complicated. This process has been part of the federal government's statistical framework for decades. Changing it would introduce discontinuity between new and historical data. And because employment data is so politically sensitive, any disruption could carry significant consequences. If something goes wrong, who's willing to take the blame? That's the core of the issue. Even though it's clear the current methodology is broken, fixing it would require major institutional courage and accountability, something that's been in short supply. Everything in this world follows the same cycle: creation, growth, decline, and eventually disappearance. Changing long-standing systems or conventions is never easy. Once a system begins to deteriorate, the signs of aging become obvious in every aspect. Employment statistics may seem like a minor issue on the surface, but it's clear the system behind them is outdated, and reversing that decay is incredibly difficult. What we're seeing isn't a political conspiracy. It's a failure of courage and accountability. The Federal Reserve has been under pressure to lower interest rates due to rising national debt and the heavy interest burden on U.S. government bonds. But at its July 30th meeting, the Fed decided to keep the federal funds rate unchanged for the fifth time in a row. Their reasoning? Employment data still showed the U.S. economy was strong, so they saw no need for immediate action. But that decision was based on the initial job numbers reported for May and June, figures that turned out to be wildly inaccurate. Just 2 days later, the Bureau of Labor Statistics slashed those job numbers by 90%, revealing that the last 3 months were actually the worst for job growth in 15 years, excluding the pandemic. Now Americans and the administration must wait until the Fed's next meeting in September to revisit the question of a rate cut. Every month of delay translates to billions more in interest payments. 2 major statistical errors, off by a factor of 9, could end up costing the U.S. economy hundreds of billions of dollars. Ironically, those inflated job numbers may have worked to America's advantage during trade negotiations. That overly optimistic data likely gave the impression that the U.S. economy was booming, encouraging other countries to strike favorable deals with Washington before August 1st. In that sense, the flawed numbers may have inadvertently helped the U.S. score big in the global trade war. Still, Trump's decision to fire the head of the Bureau of Labor Statistics over the bad data and appoint a replacement has raised concerns. Many fear it could compromise the independence of official U.S. statistics and open the door to politically driven reporting. But here's the reality. The BLS's employment data is produced through a long-standing, well-established system. It can't be easily changed or manipulated by a single person, no matter who's in charge. Everyone in government knows that falsifying official data is a criminal offense, and there are plenty of watchdogs inside and outside the government who would quickly blow the whistle. So, Trump's shakeup at the BLS seems less about controlling the data and more about restoring confidence in how it's handled moving forward. According to the revised employment data from the Bureau of Labor Statistics, there's clearly a real problem with the U.S. job market. Many analysts in the media suggest this slowdown is a result of recent policy choices: sharp tariff increases, strict crackdowns on illegal immigration, and deep cuts to government programs and jobs. These moves, they argue, have weakened consumer demand and slowed hiring. Economists have also pointed to a variety of troubling signs in recent months. Business and consumer confidence surveys show steep declines. Yet, oddly enough, many of the underlying fundamentals of the U.S. economy, such as corporate earnings, market performance, and GDP growth, have remained strong. This disconnect has left many economists puzzled. But with the latest round of economic data, a clearer picture seems to be emerging. For some, the numbers no longer contradict each other. They now believe the U.S. is at the very beginning of an economic slowdown, not the end of one. And if their assessment is correct, the future could be darker than expected, with continued softness in job growth and overall demand. But there's also a different explanation, one that paints a completely different picture of the U.S. economy's future. A recent report titled "Artificial Intelligence is Disrupting the Already Fragile Job Market for College Graduates" offers another angle. It points to a fundamental shift, not caused by traditional economic policies, but by technology. Consider one case from Columbus, Ohio. A consulting firm that typically brought on interns every summer found its office unusually quiet this year. Why? Earlier in the year, the CEO used an AI tool to generate a full week's worth of social media content, flawless, fast, and ready to publish without revision. Impressed, he canceled the internship program altogether. His reasoning was simple. AI is fast, accurate, and doesn't call in sick. It wasn't a heartless decision, it was practical. Now he gives his own kids the same advice. Don't pursue a career that AI can easily replace. Nationwide data backs up this shift. Entry-level job postings are down 15% compared to last year, while the number of applicants per position has jumped 30%. Since tools like ChatGPT entered the mainstream, companies have been rethinking their hiring plans. Top executives at firms like Amazon, JP Morgan, and Ford have publicly warned of major workforce reductions driven by AI. For today's professionals, AI is the biggest wild card they must now contend with. But AI isn't just replacing jobs, it's also fueling the economy in new ways. Major tech companies are investing heavily in AI infrastructure. According to analysts, spending on AI infrastructure has already exceeded what was invested in telecom and internet networks during the height of the dot-com boom, and it's still accelerating. The economy remains strong under tariff pressure, largely due to significant spending by large companies on AI infrastructure, which acts as a spontaneous economic stimulus plan for the U.S. economy. Data from the U.S. Bureau of Economic Analysis shows that over the past 2 quarters, capital expenditures in AI have contributed to U.S. economic growth, surpassing the total consumption of all consumers. This is an astonishing economic phenomenon. While AI has led to job reductions, traditional economic theory suggests this suppresses the development of the U.S. economy. Yet, at least for now, AI is significantly stimulating the U.S. economy through infrastructure development. Therefore, employment data in this era of AI infrastructure temporarily appears decoupled from the economic development data of the United States. In the long term, as AI costs continue to decline and its performance continues to rise, companies, driven by their pursuit of profit maximization, will increasingly replace humans with AI in various fields. This process is similar to the large-scale elimination of manual labor during the electrification of the last century. But this time, the speed and extent of replacement will be faster, affecting a wider range of jobs across almost all sectors. The wealth generated by AI for companies will grow, but the number of people with jobs will decrease. Eventually, we may find that the stock market, economic development, and various economic indicators could become decoupled from employment data. Some believe that AI will eventually bring about a future of widespread material abundance. But for society, the real challenge won't be creating wealth, it'll be figuring out how to share it. Wealth distribution is shaping up to be one of the most important issues of our time. Sure, Some people will profit from AI-driven growth through stock ownership in the right companies, but most won't have access to those opportunities. So how will we move from a system where wealth is tied to jobs and labor to one that reflects a very different economic reality? That's a question the entire world will have to face. AI's impact won't stop at technology or employment. It's going to reshape the very structure of society. Figuring out how people live and how wealth gets distributed in the age of AI will be a major challenge for every nation, especially large, self-contained countries like the United States and China. When major societal shifts occur, a country with a strong rule of law and democratic institutions is more likely to build a new social framework, one that takes all groups into account and strikes a balance between logic and compassion. Now let's refocus on the next 3 to 5 years in the United States. From that perspective, one key point stands out. As AI continues to play a larger role in both the US and global economies, many traditional economic concepts will start to evolve. Metrics that were once closely tied may begin to diverge. For example, even if employment data remains weak, the economy could still grow thanks to rising individual productivity driven by AI. Corporate profits might keep climbing, and in turn, the stock market could continue to rise. In fact, we're already seeing signs of this in the current U.S. economy and markets. Politics is full of dramatic moments, and people love to talk about it. But when you zoom out and look at history over the span of a century, it's not politics that truly reshapes society. It's technology. The tools we build and the level of tech we achieve have a far deeper and longer-lasting impact than any short-term political event. And the technologies that change how we live don't just appear out of nowhere. At the same time, the world they create is rarely something we fully control, just like what we're seeing now with the rapid rise of AI. No one is really in control of where it's going,